Good morning, everybody, and welcome. This is the Saturday morning Viper Trading webinar. If you're here to learn about trading futures markets with the Viper tools, you're absolutely in the right place. Let's go ahead and get started with our standard disclaimer. Excuse me. All communications from Viper Trading Systems are for educational purposes only. Futures trading does involve risk, and there is a risk of loss. Nothing contained in this webinar or other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody in here this morning does know that you do trade at your own sole discretion. Okay, any questions on the disclaimer? All right, before I get to the charts, I'm gonna check. I think I'm seeing most or all of you, most of you were at the part 1 session of this, which is done trading in an hour or less. That was Thursday night. Excuse me. I have to apologize. I have a little tickle in my throat this morning. And so what are we trying to accomplish each morning or each day when we trade? This is a pop quiz from the first thing we discussed on Thursday night, the part 1 session. What are we trying to accomplish when we trade every day? This should be really easy. We all should remember this from our discussion last Thursday night. What are we trying to do? So in other words, think about this. Why, I mean, essentially this is going to the heart of the matter, which is why are you trading in the first place? Why do we trade? Why do we risk our capital, put all our time and money and effort into doing all this, setting up all the charts and learning, you know, different types of trade entries? Why do we even do it? What's it for? Excuse me. What are we trying to accomplish? Good. So I see some of you were in the Thursday night and you remember. We're trying to achieve our daily goal. That's our profit money goal quickly. Yes, reach our goal, make money. It's our business, right? So when we think about that, that begs the question of what is our goal? Does everybody have a profit goal? I do. Every day when I wake up, I know exactly how much money I'm trying to make. So if everybody knows, you know your goal, go ahead and type it in. Everybody has a goal, right? I mean, that's one like the most fundamental things that we teach and what we do here. What's the goal? Do you have one? Maybe you don't have one. And if you don't have one, it's perfectly okay. If you don't have a number to put in there, that's perfectly okay. I would strongly urge you perhaps take some time this weekend to think about setting a goal, because it's probably one of the more important things to have. You got to know what you're trading for. And think about it this way. Here's a quick analogy while all these numbers are coming in. It would be like this. It would be like having a business. You're starting a business, and you sort of know what you're going to do for the business, but you don't know, you know, whether you're successful or not, because you don't have, there's no way to measure it because there's no goal. Okay, I see some numbers. A lot of the numbers are around 500. I see a couple of them around 1,000. You know, you know, your profit goal is a personal thing. You know, the important thing is to have one. That's the bottom line. Okay, you should have a profit goal and try to achieve that as quickly as possible with as few trades as possible early in the morning. Let's get over to a NASDAQ chart from Friday on screen 1. Right here. Now, the open of the market is 6:30 Pacific. I'm here in California for those of you that are new. So all the time down here is in Pacific time. So the open of the equity markets is 6:30 Pacific, which would be right here. Right here at the edge of this chart. And so my first question to the team here this morning is, going into the open here, is this market trending, yes or no? And if so, if the answer is yes, what direction is the trend? We're right at the open on Friday morning. We're trying to recreate Friday morning here. So going into Friday morning's open, Was this market trending, yes or no? And if your answer is yes, what is the trend? Let me blow this up a little better so you can see it. It's all kind of scrunched up there. Hold on a second. I'm going to assume most folks here this morning, or everybody in here, has seen the Thursday night webinar. That's why we're doing the part 2 here. So if you haven't, you can go back, later on today or this weekend and look at part 1. So I'm going to move quickly into some more advanced topics. I'm not going to cover all the basic stuff that I did on Thursday night, okay? Yeah, good. Yeah, the trend is up. Trend is up, characterized by the fact that we have, some days I will do this. I will go ahead and draw a trend line under the lows. Just visually, it's very quick and easy to do. You can see very quickly and easily here. Of course, we had other clues here that, excuse me, the background was green. The bars are generally blue. All the bands, including the mid-band, are stair-stepping up. We had several, pullback consolidations at or near the mid-band here. You'll notice that when the bars come right around the mid-band, sometimes they turn yellow. With the deep, what we call deep probes, where they go a little bit below the mid-band, they occasionally turn red, but that's okay. It's still an uptrend. Hey, Diane, good morning. A lot of you still just coming in. Don't worry, I know, we just got started. Hey, Daryl. We're just getting started. We're a few minutes into it. You haven't missed much, and we're recording it, of course. So let me ask another question. Everybody got that right. The trend is up going into the open, and so we're looking for long trades. Now, let me ask this question. Is there a trade here at the open setting up? I'll help you with the first couple. I'll help you out with the first, because it seems like everybody's still kind of waking up a little bit. That's okay. I'll help you with the first couple. All right, let's do that. Let's do it this way. So here was our deep probe, where we come just a little bit below the mid-band here, and we consolidate. By the way, I'm going to make a quick comment before we look at the open. If you had boxed in the pre-market session, it's quite possible you could have boxed this area in right here with a long bias, and so you would have not gotten sucked into a short. If you missed that one, in the pre-market session, there was several other entries. There was one right here, right to mid-band. In the pre-market session, if the market is trending, you're going to want to bias towards the direction of the trend because of the liquidity issues, the spreads, all the things we talked about Thursday, right? Here, of course, you had another box here. This would have been early in the morning, 5 o'clock, 8 o'clock Eastern. Long trades, long. And if you missed that one, you had, of course, another nice little box form right here, which got a quick pop up to a fresh swing high right here. All right, so now we've recapped into the open. So yes, many of you have typed in that at the open we have a mid-band retracement, and we're looking to get long down here on a bounce off the mid-band, and that's precisely what we got. Somewhere right in here. So right at the open, yes, you could have been buying this long. Many of you got that. Perfect. So let's see what this turned into. This early trade, first thing right at the open. Let's see what we got out of it. Here we're popping up. So let me ask a secondary follow-up question to Thursday night. When we trade NASDAQ and YM and other instruments, how many contracts do we usually try to trade, and what do we like to do with them? What's our approach? How many contracts do we generally like to try to trade, and what is our approach if you were just sum it up in a couple of words? Testing here to make sure we're all sort of on the same page and everybody's awake. You had your little cup of espresso. Ready to make some trade calls here? Give you a second to respond to that. We all should have this pretty much figured out right now, right? I mean, some of you have been coming to many, many webinars. You should just know off the top of your head exactly what our approach is. I'll help you with the first part. Yes, we are retracement traders in trends. So we never buy or sell the thrust move, right? So we all know that. What do we try to do in our approach as we trade these markets? 2 contracts with a scalp and watch for the runner. Kenneth, perfect. Anybody else? Adam got that too. Richard, Stephen. Okay, good. Yeah, you try to get at least 2 contracts if you can. You know, put 2 on if you can, and 1 would be the scalp, which is the initial pop, 8 to 10 ticks, which of course you can see we got right here out of the box. Taking out generally, not always, but generally speaking, there's going to be some kind of swing close by to pop up 2 from the mid-band bounce. So we would have been filled long on this bar right here. Out of our little region box at the mid-band, we're long right here. And 10 ticks would have put us right about here. Let's see, 40 to 35 and 3. So 10 ticks would be, let's see, 2.5, 37, 38. Yeah, right about here. Right about here would have been your 10. So, and I'll just quickly recap our approach. Our scalper target that we set inside of Object Trader at 10 ticks would be achieved right there, depending on your fill. And our initial stop, which is usually 10 to 12 ticks below our entry, would be located down here. That's our initial stop. OT puts that in for us automatically, right? And then we want to set it up so that you can do this in an automated fashion with Object Trader, set it all up ahead of time, or you can manually do it once you're in. Bring your stop up to 3 ticks behind your entry once you have achieved your first target. So what I'm saying right here in this trade approach is the sort of the fundamental basics of how we approach every trade. So what we want to do as we're developing our trading skills is make certain that these critical, simple, very fundamental basic elements of trading are just really sort of ingrained in our trading psyche. This is how we approach pretty much every trade. Now, the entry type might vary. You know, you might have, you know, you're selling a rollover at the top or a news event. So we have different types of entries. They're not all mid-band boxes. A lot of them are, but some of them aren't. However you get in, the management of the trade that occurs after your entry is critically important. It's like, you know, you can't just say, okay, well, I'm in now. Now this should start making me some money. You know, you got to do some trade management after you get in. And the first part of it is this first critical step, learning to peel that first contract at the scalper target and taking your initial stop up from 10 or 12 ticks below here, down here, wherever it is, and bring it right up to 2 to 4 ticks behind your entry. This ensures that we have what's called a free trade. In other words, if this market crashed and cratered, hit its head, and some catastrophic thing came down, boom, took us out, we would still make 6 ticks, yes? You have a profitable trade now. This is why this is so critical. This very simple thing is ensuring you have what's called a free trade. Free trade means it could go up or down. It doesn't matter. You're still going to make money. Okay? All right, let's move on. Now, the market starts to ascend, moving in our favor on Friday morning. It depends on how aggressive or relaxed your stop posture is in terms of how you trail it. I'm going to let this move up, and I'll discuss that in a second. We're moving up, we're moving up, we're moving up. Now, let's talk a minute about stop positions. And you've heard me say this hundreds of times, so I'll go very quickly because you're probably tired of hearing it. Notice, and let me just show you a little more in detail, because sometimes I don't show this as well as I should. Notice these lines here. Okay, let me work back from here. So here's the peak of the thrust up, 46, right up in here. See it? And it pushes the outer limit of the outer band right here. See it? All right. Now, Notice how it comes back and plows through this line right here, just under this second band. This would be an aggressive stop posture. If you are a trader who likes to get in and out of trades more in a scalping type fashion, even in trends, so if a market is trending, you don't mind getting in and getting out, getting in and getting out, back in and out. If you are a trader who likes to take runners and you're willing to give up as much as 10, 15 plus 20 ticks perhaps on the runners just to let them run so it becomes a continuous trade, well then you would use a less aggressive stop posture. What that means is you could conceivably have your trailing stop as low as there. Now, what is occurring on this chart right here as we speak? This would have been 4 minutes into the trading session. What is happening right here? It's 6:34 Pacific. You're 4 minutes into the trades. Excuse me. Sorry. Hold on. I'm going to take a sip of tea while you're answering that. What's happening right now on the chart? Anybody? 6:34 on Friday morning. This is NASDAQ. I believe we traded this and called this out. Pretty certain we did. Good. Yeah, it's tight consolidation right at the midband. Buyers and sellers striking equilibrium. Time to box it in and look for a long trade. Good. Absolutely. You set your region box right here. Or you could use your line tool. Or you could use your ray tool out of Object Trader. Several different types of tools you could use to get into the trade, yes? Is everybody following along with that? Everybody see what's happening there? Okay, good. Many of you have typed in that you're looking to get long off the mid-band bounce. Perfect. Yeah, now if you'd used your line tool or your ray tool or the region box, in all likelihood you were probably filled long on this bar right here. Now you got to go 12 ticks below that for your initial stop. So you're filled at round number here 41.50. So your initial stop would be located down in here somewhere. I'm just doing this quickly because I'm trying to get through this trade. 2 less 2.5. Yeah, somewhere down in here would have been your initial stop, right? Excuse me. GW, you could, it depends, you know, this is a pretty powerful uptrend here. His question was this, would you have a bias at this region box right up near the open time? You could have no bias here. It's possible you could have no bias. If you have no bias, I would engulf this lower swing just a little bit deeper in case you had some issues over here where it tests it. Let me show you what I'm talking about. So I would take this region box and go make sure I really got that engulfed right there. Let's go ahead and advance this. Yeah, see, so we come down, we poke up in here right to the, and we come down and we sort of wick the bottom of that box right there. We don't hit the stop. It doesn't reverse. We're not taking the long at this particular time. And if you had missed this entry and came in later around 6:35 with your box, or you had taken a ray tool or a line tool and did a looser interpretation like that, then you would have been filled on this bar right here. So the late birds would have got in on that bar. The early birds would have been in on this bar right here, long. Daryl, I know there's different ways to configure the region boxes with Touch Plus 2. I know Gary does that quite a bit. In fact, sometimes he's filled just off the bottom of the boxes. That's another way to do it. You know, there's a couple of ways to manipulate these boxes. I personally prefer a close above in terms of a long region box at the midband. But you could do a touch plus 2 off the bottom of the box here, and you'd be filled in this bar right here a little earlier. You know, there's different ways to get in here. Obviously, I'm not going to cover all of them, but bottom line is that we're looking pretty much for a long trade off a bounce right in here. Whatever tools you use to get in is your choice. And yeah, I would suggest, especially if you're learning object trader and the use of the tools, go into sim for a while and just experiment with them and play with the different settings until you get really comfortable. Because you know, in real time, this is moving around pretty quick. So you know, you know, it's tough to try to learn how to use the tools in real time when it's flying all over the place. You got to pretty much kind of master the tools so that when you're trading in real time with real money, you know, you can sort of fight the good fight there, right? Okay, good. All right, so we're long again. This is our second trade of the morning, and she pulls back, checks the midband, heads up, heads up, heads up. Heads up is heading in our favor. Let's talk about trailing stops for a second. And I want to show you a couple of things here. With the tight trailing stops that follow either the stealth line, which is this sort of smooth line that follows this line right here. When you pull back off that thrust into this swing right here, if you had a tight stop right at or just below that line, you were okay. Now, in some cases, when you get retraces that just slightly pierce through the line, as in right here, it could ding your tight stops. Okay, so that's the risk of extremely tight stops when you get into runner situations. Oh, let me back up. First of all, of course, everybody sees that your scalper target would have been achieved somewhere in here. 10 ticks, right? And just another side comment on this, just real quick, okay? Just so I don't want to get too distracted in the minutia of this trade. Notice how we get a quick pop on this bar right here, and then we come back and we check. Now, this is important. You would not have moved the stops, GW. You would not have moved the stops because you did not achieve the scalper target with this bar right here. Your scalper target is up near the swing, up here. Let me put it on the chart. 10 ticks would put you up here somewhere, right around this swing. By the way, let me just pause for a second. 10 ticks is not a set number, okay? We lob that out all the time on your scalper target. It really is a function of how close that next swing is located. So for instance, and this is something you have to work on your chosen instrument. Crude oil is different than the Russell. YM's a little bit different than NASDAQ. NASDAQ obviously different than the other three. Okay, what I'm saying specifically is this. You want to look for where the swings are located, as we did here, and as we did here, for your scalp target. Sometimes that can be 4 or 5 or 6 ticks. It's not always 10. Okay, so we just put out 10 for the sake of identifying the fact that you do have a scalper target. Let's see in this case for NASDAQ how many ticks that would really be. You're filled long on this bar right here at 42, and 46 is located here. So that's 4 times 4 is 16 ticks. Now, when you do this math and you analyze your market, and you see that typically it can move 12 to 16 ticks, you're going to err to the inside of that. You're fading it, right? You're not going to put your scalp target right at 16 because there is a chance that it could come, not quite hit it, roll over, and you never get it. Everybody see that? So study where your swings are, and that's essentially pretty close to where your scalper target's going to be located. Second of all, when you get a quick pop like this, and you get many times you'll get this follow through sort of recheck of the box or the midband as you got right here. You would not immediately take your trailing stop up to 3 ticks behind our entry simply because we have not achieved this target yet. Now, arguably it did move in your favor a few ticks. If you were nervous about the 12 tick stop, you could take it up a little tighter if you wanted to. Excuse me. I would not take it up into here because it would have stopped you out by just like a tick or two. Here's your entry. It just would have stopped you right out. And you know, when you got nice, powerful, trending, big, strong, moving markets like this, you got to let them wiggle around a little bit. Third thing, if you did for some reason move your stop and it nicked you out right here with these two bars, just nicked you out, you could always re-enter right here as it went back up and back out. Everybody follow what I'm showing here? When you pull back close to a runner stop, do you add additional runner in the case the trend resumes to increase the possible gain? I know Gary does that a lot, Ed. I usually don't do that. You could do that. So what he's saying essentially is this. He's saying, so okay, you got this initial, let me just show it a little more in detail right here. Okay, so we got this initial pop, not quite to our scalper target, not quite to it, but we're in the green. It pulls back, we're slightly upside down, and it checks this higher swing at the mid-band. If you did not move your stops, you're still in the trade because your initial stop is still down here, right? If you pull back, what he's saying is, can you add to it? If you're already in, it pulls back and gives you a second chance to add to it on another subsequent bounce right here, or any of these bars right in here. Yes, you could do that. So let's say hypothetically you had 2 on the fill of this bar right here. It pulls back, it checks here, you see the momentum is taking it right back up through and filling you, you're getting green. Go ahead and pop another 1 or 2 on there, yes. In that case, let's say you added 2, you'd be long 4. You'd want to go ahead and peel 2. Remember to increase your stop. Increase your stop, right? Go ahead and peel the 2 here, and then let the other 1 or 2 be the runners. So what we're describing here in this first trade at the open and this subsequent second trade at 634, 635 are pretty much sort of ideal conditions. These are ideal conditions for trade entry and management. Everybody see this? Okay, so we get to our scalper target. We go ahead and pull our stop up. In fact, we could get more aggressive on that now. We can actually start to follow it up here. Now, following the stop, following the stop, following the stop. This is what I was saying up here. If you were very aggressive on your stop posture, either a tick under stealth or under that line right there, it's quite possibly the wick of one of these guys would have got you. By the way, you don't have to, you know, freak out. Many traders who get stopped in a very powerful trend can go ahead and get right back in. Now, if you're going to get back in after a thrust and a minor pullback like that, then you got to really go ahead and make sure that your stops are tight on the subsequent final move, which is this thrust right here. So essentially, this trade would have looked like this. No question that when you got, you know, when it came through here, you're getting out of it at this point. And this trade right here to the left looked like this. So let's talk about money. Let's look at our two contract approach and quickly add up some money because we're here at 642. We've been trading almost 15 minutes, 10, 12, 15 minutes here. And let's look at the runners. You clearly got the 10 tick here, no question about it. And your runner would have given you, depending on the tightness of your stop, 43 from 35, 8, 32 ticks. Let's just add up ticks, and then we'll do the number at the end, okay? So the first trade would have been 10 plus 35 is 45 ticks. Second trade was 10 plus, I don't know, let's call it 42 to 53, 11 times 4, 44. So that's 20, 55, 99 ticks times 5. So by, 642, 12 minutes into the trading session, you've had 2 trades and you're up right around $500 plus or minus on 2 trades. How many of you would be done? You've achieved your goal for the morning. This is what we want. And remember, we at the very outset of this webinar, we said the very first thing that we said. Remember, our goal and our purpose of trading in the morning or whenever you trade is not to trade as many trades as we can find, right? That's not what we're there to do. We're not there to overtrade. We are there to achieve our goal. You took 2 trades and you're right at 500 bucks. You might very well be done. GW's done. John's done. Good. All right, let's see if we get any other follow-on trades. Let's advance the chart and see what else happened here on NASI on Friday morning. I'm just gonna advance this quickly because we're gonna get off of this. We spent a big chunk of time on this chart. Let's just go ahead and advance and look at what's happened really quick. Yeah, it came down just almost got the mid band. You got one final thrust. We got a double top. I think we had some news Friday too, didn't we? Wasn't there a sentiment number, as I recall? Let me double check that. Yeah, I think there was. Wasn't there a sentiment number? Kenneth, yeah. Yeah, you could. Kenneth is asking here if you had done more contracts, where would you wind up there on the 2 trades? Yeah, if you went in with 4, you know, if you want some parity with your trading, yeah, you would have peeled the 2 conceivably at the scalper on each one, scalper targets. You would have peeled 2, and then in that case, of course, you would have had the 2 runners, which would have been stopped out at wherever your stops were for the second leg of the trade, if you will. I tend to err on the side of more leverage and less trades. Just over the years, that's kind of the style I've developed. So, you know, most of you know I put 20 contracts on in the morning in the early volatility stages of this, so you can do the math. I'm typically putting anywhere between 10 and 20 contracts on, especially when I see big moves like this. When I see big moves like this, I load for bear. I'm loading for bear when I see this. This is handing you money. Now, look over here what happens after right around 7 o'clock, just before that news came out. Notice we got sort of a double, triple top here starting to form. And I think this happened on the Russell and YM. And you can start to see it here that we're getting consolidation at this upper level. Just right ahead of the news. So, you know, there was a couple of more trades that set up here. Obviously, you can see the one right here as we started to consolidate at this upper level. But the first clue that you start to get that we're not necessarily getting trend continuation is what? What's happening here? Diane, with the 20 on, I'll usually peel 5 off right at that first pop. That'll leave me with 15 on the runners. Same with 10. If I had 10 on, I'd peel 2 and let the rest run. And then most of you know, of course, yeah, exactly. Let me follow on to the question real quick here. On these subsequent thrusts that you had here off the midband, and you had here off the midband, we did not take this top out. Okay, so what, and we observed this in real time in the room, like in the Russell. I know this happened to Gary, or maybe the Russell just broke that by 2 ticks and then rolled. You're starting to, this is starting to show you that the momentum to the upside is starting to wane. We're not getting follow through with subsequent thrusts. The buying is starting to run out up here. So what you want to do, back to Diane's question in regards to multiple contracts, and this is tied in somewhat with Kenneth's question about having 4 contracts on. You generally want to peel at least 2 you know, let's give a rule of thumb. Let's say 25% of your contracts, however many contracts you have on, should be pulled at the first pop. So your scalper target, if you're in multiples, you're going to peel 20-25% or whatever that number is. So if you're in 4, you're going to want to peel 1 or 2. You know, 5, you're going to peel 1 or 2. 10, you're going to peel 4. And then you let the rest be the runners. Okay, when you're looking at trading multiple contracts on these entries. Now here, when we talk about scaling, scaling is an issue of when do you load for bear and when do you not load for bear. Clearly you can see in this uptrend that started way back over here in the overnight session, this is load for bear material, especially when you're getting nice respect of the swings and mid-band. This is loading for bear. If you're going to do multiples, this would be the scenario to do it. Right here, this trend move right here, like that. When you see that, that's load for bear material. Now, look at what happens over here. Are you loading? Let me put it a different way. In this scenario over here, are you loading for bear? Is this a situation here where you're loading up multiple contracts when a market looks like this? I'm circling it with my cursor. No. No, 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 no. When a market starts to consolidate this is when you start cutting back. This is not load for bear. Okay, this is where you cut back. I might scale back to 1 or 2 or 3 or 4 in there and just scalp the tops. That's all I would be doing in here. So in other words, what I'm saying is you can't just say, well, I'm going to trade, 4 contracts. I'm going to trade 4 contracts all day. All day long, I'm trading 4 contracts. There are appropriate times when you leverage up. And for me personally, and this is just, my suggestion, my personal style, when I see ranges start to set up, even though the trend is still up and you got some nice, decent scalpers here, I'm not putting the full boat on here. This is not the full Monty for me. I scale way back when I see this. And then I see a run come, a nice run, there I'm loading it up. So it's a judgment thing. You have to roll with what the market's doing. If the market has a strong, powerful uptrend, that's where you make a lot of money. If you're going sideways and you're scalping, not so much. Question coming in from Daryl. How would you scaled out of the trade as it did in the first yellow bar at the pullback at 643? Oh, I think he's asking about how we would have gotten out and back in over here at 643. Okay, let's blow this. Let me take some of this off of here because I know it's starting to get a little confusing. I think his quick question is related to this initial pullback right here. There's 2 places to get in here, Daryl, in my view, on this consolidation area ahead of the news at the sort of tail end of this powerful uptrend move. You could have used your tools and possibly boxed this in above the mid band, and been or array or region or line tool. You would have been filled on one of these bars right here. Your initial stop would have been down under the mid band, so this wick did not get you. If you were less aggressive and you prefer entries closer to the mid band, it's possible you could have been in on a bar reversal off of here, either on that bar or long on this bar right here. And then of course you see you would have been trying to fade that top at 46 and you would have gotten out. When you start to see that you're not getting up and pushing through here, you would have got out on this bar right here and then re-entered on this box right here. So this was 2 trades in this region, 2 trades. Long here, or long here, and long here on this bar right here. I think we watched this in real time. We were buying this. Remember, we caught these 2 early trades, and then we were buying. I remember trading this. And we got the pop here, we got the pop here, and then it came down, stopped out, and started to head south. The second trade, Daryl, would have stopped out depending on how tight your stops were, right in here. Right where the circle is, right here. So yeah, I mean, this was a little bit challenging. You probably would not have put a box right there right after you stopped out. Okay, any final questions? I don't want to spend the whole morning on this chart. I hope that helped. I know we spent a lot of detail on covering a lot of topics on this chart. Let's get another chart up. Do you want to see some crude oil? Anybody? Crude oil chart for anybody. Let's see if anybody's interested in crude. Any crude takers? Okay. Let me bring the chart down. Stand by, please. Let's go back to early morning on Friday for crude. That would have been 6 o'clock Pacific time. At 6 o'clock, the crude market looked like this. Daryl, I see your question. I'm gonna do this if I can. Let's table that because we've spent the better part of 49 minutes on that chart. Let's do this. Let's try to power through a couple of oil trades here, and then before we wrap up, Daryl, we'll circle back and try to sort out that question in regards to the end of that second trade. Okay, just real quick. Okay, all right. Let's get crude up here. 6 o'clock is right about here. And let's go ahead and show the crude chart on Friday morning. So it looked like this. Here's 559, here's 604. So the pit open was right here. So even before the pit opens on crude, what's the first thing that we can observe from this chart? And this is, by the way, this little exercise we're going to do together is how I normally, every morning, you know, when I come into, excuse me, and actually, everything is all set up ahead of time. Most of you know, I reboot, scrub the database, connect to everything, get all my charts are all set up. Everything is good to go on all my screens. So when I come up in the morning and I get ready to trade, I just turn on my monitors and everything is ready to go. Now, if you don't want to do that and let your machine run all night, I understand that. But what you need to do is then get in there a little early, you know, connect to your database, get everything all set up, get all your charts ready to go, so that when the market opens and starts moving around, you're ready to take trades. So when I start looking at the market, what is your observation of crude oil prior to the pit open at 6 o'clock? I mean, if you looked at this chart early in the morning and you're trying to decide what to do with crude oil, what would be the first thing you would notice? I mean, it's jumping right off the screen. What would you notice? I'll help you a little bit. Is it trending? Is it consolidating? Is it breaking up or out? Is it the mid-band? What's it doing? What are you going to do? So the reason I'm asking this is that when we talk about done, you know, 1 or 2 and done in the first hour, in order to, you know, to make money in the first 30 to 60 minutes, you're going to have to do some quick chart analysis because you're going to have to know kind of what you're going to do right away. Yes? It's in a range. Chop. Not trending. Sideways. Good. Yes. In fact, you know, we could take 2 horizontal lines. You could pretty much put one down here at the support level. You can call this area support. Yes? Been down here 1, arguably 2, 3, 4 times. No question there's support down in there, that area. And you could arguably put another one right up in here. I think we all would agree you can make the case that as long as she stays within the confines of these two lines, we're pretty much in a range, yes? Now, pop quiz from other webinars we have done on this topic. When you are range bound and the mid-band is located approximately in the middle of the range, is it a good idea to take mid-band boxes? Let me repeat that. If you're range bound, like you are right here, right? You have a clearly defined top and bottom to it. Generally speaking, no. Yeah, generally speaking, no. You're not pretty much going to want to trade those. You're trading the extremes. You're buying support and you're selling resistance, or you're selling resistance and covering at the bottom, or you're buying support. You're trading the range itself. Yes. Now we had some other interesting comments come in from the team here. Diane said you could take those trades, but you must scalp the tops and the bottoms in either direction if you get in. Yes. That's what I was going to say. So let me be clear about this. When we talk about a range, what are we saying? We're saying that you're generally buying the support area and taking scalper profits at the mid-band, and then your target would be fading the top of the range, right? So that's our approach to a range. Now, so we're taking profits up here, and so should you choose to do so, you are shorting the top of the range. Your scalper target is here, and you're looking to cover at the bottom. So that's how we trade ranges, right? Buying, scalper, cover, roll, scalper, down, cover, back up, scalper, mid-band. So what we're saying then is that if you're going to choose to box the mid-band, you did have a few. Okay, I'm going to show them. You had a box there. Arguably you had a box here, which could have actually flipped you up long scalp and a short scalp. So I mean, it's possible. If the range is wide enough to give you some coin, some scalper coin, well then, you know, generally speaking, you wouldn't want to do it. You want to trade the extremes of the range. Generally, that's what you want to do. But if you chose to try to do this, you got to have a wide enough box to give you some meat to get in and out. Everybody see that? You know, let me just say this. If the box was only about this big, you know, if the box would look more like this, say, what is this? Maybe, you know, 14 ticks, 18 ticks. It's just too tight. I mean, by the time you got filled short, you got to get right out, right? If you get filled, you barely get filled and you got to get out. The top of the range is right there. Now, if you got a 50 ticks range like this, here, let's see how large this range actually is. Okay, 45.90 is support, resistance up. Yeah, I mean, you're pushing 40, 45 ticks. So at the mid-band, there's enough meat to get a scalp on a mid-band pop. Everybody see the difference in the types of ranges we're talking about? Very tight ranges, pretty much, yes, you want to avoid the mid-band. Larger ranges like this, or even larger, yeah, there's enough meat to scalp. But in reality, the true way to trade the range is buying and selling the extremes of it. That's where most of the money is made. In those circumstances, you're actually scalping the mid-band. So by the time you get here, these little boxes, those of you who are actually trading the range are already in the trade and making money. Everybody follow that? All right, well, let's advance the chart. Here's 6 o'clock. So there was some trades here in the pre-market, no question about it. So now you come in at 6, and let's just roll this market forward on Friday. I'm sure Gary and whoever was in there traded this. I'm going to go ahead and advance it for the first 20 minutes, and we'll talk about what's set up here. Okay, here's the market. For those of you who did do a little bit of mid-band trading there, I'm not sure exactly how Gary traded this, but you had a couple of scalpers. One that started to turn a little bit into a runner. You had this scalper here, and then you had a second one right here that hit that first target and then started to try to turn into a runner. And let's see what happened to it. Yeah, see, then it stopped out and came right back down here. So it was pretty choppy. Anybody remember this? He came back to the bottom down there. And another sort of mid-band box here. Truth be told, I don't remember how this was traded. Anybody remember how this was traded? Were you guys taking trades in here? Did you catch this long? Anybody remember? I wasn't in the room at that time. I didn't come in until like almost 6:30, 6:25. Yeah, he was buying support and selling resistance. Okay. All right. So, you know, so what I'm trying to impress upon you here is that when markets look like this, and you're in a range and you're taking some little scalper trades like this with maybe 1 or 2 contracts. So just to be clear, when I see a market like this, I am not loading for bear. This is not load for bear material. Would we all agree that? This is trade lightly. Scalper targets, quick, get in and out, get your stops tight, get out, get in, get back out. Only put 1 or 2 contracts, 3 tops, maybe 4. You're not putting 10 or 20 on here. This is not load for bear material. You got another little short trade here, right 7 o'clock, right after the news. Let's see what happened to her. I think she started to break down a little bit. Very choppy here. See that? Rolled over right here, back up to mid-band. So let's level set our expectations when we're trading chop like this. How much money are you making on each of these trades? Say you had 1 or 2 contracts. How many ticks are we getting here? This would have been kind of the longest run of the morning right there, huh? What are our expectations when we see choppy markets? I know most of you are rolling your eyes and you already typed it in. No, I'm staying out. And you could have. I mean, the fact of the matter is, if you don't like markets that look like this and you just don't feel comfortable or you can't make money trading them, then we have talked about this. Then you stay out. You go look for something else. Go over and look at the Russell chart. Take a look at the NASDAQ. Pop up the YM chart. You should already have them on your screen, right? You see this? You see the scalpy chop? Here we are, 30 minutes into the trading session. Okay, here's 6 o'clock right here. All right, there's the pit open. So you're watching it. You're watching crude. You already knew in the pre-market session it was choppy, right? We said that. We already knew what the range was. Before the pit even opened, we had these lines here, so we already knew it, right? Pit opens. Maybe we take that trade, maybe we don't. Still chopping around, chopping around, chopping around. There's 6:30. 6:30 is right here. So here's 30 minutes into the trading session. There's 6:30, 6:32. So 30 minutes into the trading session, and this is what crude oil has done. Now, let me ask the question. With this type of price action, is this the type of price action that's going to allow you to go 1 and done or 2 and done in the first hour? Let's advance it a little more. Here you are at 6:45. You're 15 minutes into the trading session. You've had essentially 2 trades. This one would have made you about, I don't know, let's say you got filled here and you got out here. What is that, 8 ticks? Maybe 8 ticks. Here you got filled here at 20. And you got out at 15 ticks maybe. Total opportunity here, I mean, between 2 trades, you're looking at somewhere around 20 to 25 ticks. Does everybody see that? So I want to be clear. There's no, sometimes I Skype and I talk with traders all the time, and there's this sort of feeling or consensus that there's some magical trick here, or markets are rigged against you, and they always know when you're getting in, and there's some the big guys are plotting against us. You hear all sorts of comments like that, right? Well, a lot of that, I don't know, possibly it's true. I don't think it's true. I think the market is what it is. You have price action, and you're either in a range or you're trending for the most part, right? I mean, that's kind of the 2 primary market conditions, and there's nothing evil about it. Nobody's plotting against you. You just have to decide whether you're going to trade it or not. And if you don't like this type of style of trading in these ranges, well, then you simply avoid it, pull up another chart, and look for other entries. But the bottom line is it's going to be very difficult, as long as this market stays within these ranges, to load for bear and knock it out of the park and have a nice long-running 1 or 2 and dones, kind of like we had on NASDAQ over here. So contrast the first hour of this on crude oil with what we saw on NASI, which looked like this. 2 very different markets, right? 2 very different markets. And so we have to be able to quickly spot and discern where we're going to put our attention, because that decision will drive whether we're making money or not. Let me be clear so it's easy for us to do come Monday morning. When you came in early and looked at NASDAQ, I'm going to put these two right next to each other so I can illustrate what I'm talking about. You came in early and you looked at crude. Crude looked like this. Okay? This is what crude looked like. When you came in early on Friday morning, crude looked like that. And when you came in and you had your NASI chart up, NASI looked like this. Now, I know it's confusing. I have all these lines on here, but when you have two charts next to each other and they look like this, which one are you going to pick to trade? That's my final question, and we're going to wrap. If you have two charts in front of you on your screens, and one looks like the one on the right, NASDAQ, or the one on the left, crude oil, and you want to pick one, okay? You don't want to be torn between juggling a bunch of screens. And by the way, a side note while you're answering that, I know, what the thinking is many times with a lot of traders is the more charts I have up, the more opportunity as I have. I would like to suggest to you the opposite. The more charts you have up, the more distractions you have. You are much better off, please heed my words here, having one or two charts and becoming an expert in those one or two instruments than to put 4 or 5 charts up and be distracted with all manner of markets all over the place. Because then what you're doing is you're looking over here and a trade sets up and you miss it, and you come over here and the thing bounces and you're chasing it, and then you get over here and you scalp and you lose money and you get out and you're back and forth and you're looking over there, you're distracted, you miss the trade setup. Instead of being focused on 1, 2 charts tops, you're looking for opportunity all over the place and you miss the ones that are right in front of your nose. All right, I'm going to go ahead and stop the recorder.